Hi, are you looking to get started in the financial market? You want to know some information about stocks, shares, or how to start in the stocks and shares market? Then this video is right for you. My name is Manu Matthew, and I'm going to walk you through some of the critical and basic things you need to know about starting in the stocks and shares market. To get you started, some of the basic things you may have come across already when you are looking into stocks might be stocks, funds, and bonds. I'm going to walk you through what each of them are. When you generally say stocks, it's usually referred to individual company stocks or shares of the company. So when you purchase a share from a company, you become part owner of that company, no matter how small or big the size you purchase. Purchasing individual stocks or shares of the company involves much higher risk because you need to do your own due diligence in order to make those purchases. You need to read through financial statements, what their cash balance is like, how much dividends they pay. Individual stock purchases are more of an active investment strategy because you do need to be heavily involved in the stocks you purchase. You need to do your own research, read the financial statements. All this research needs to be taken place before you make the purchase of your stock that you're interested in. Usually there are a lot of hype around particular stock at certain given time. It's important to avoid all that and look at the basics of every company and understand what they have underneath. It's important to understand the company financials, what their projections are like, what their growth model is before you make a purchase into an individual stock and shares in a company. An advantage of purchasing individual stocks or shares from a company would be that you can choose the company that might suit your investment strategy. One company might be great on capital gains and another one might be great with dividends. Depending on how you strategize your investments, you can make the right investment with the right company. Another great way to make a purchase into the stocks and shares market is via purchasing a fund. A fund is just a collection of companies grouped together. The grouping can take place by very different metrics. Some funds are grouped together based on the country they are located in. Some funds are grouping the companies together by the industry they are based in. So a fund could have hundreds of companies inside. For example, one of the fund you may have heard of would be S&P 500. S&P 500 is a list of companies that are based in US. They are the top 500 companies within the US. The advantage of purchasing into a fund would be that you can look into its history and see that it has always performed very well. It has a very good track history. You can purchase into a fund and then completely forget about it. It can be a passive income. You can come back in 10 years and take your earnings from it. When looking into funds, you will find there's mutual funds, index funds, and ETFs. It will be a video on its own to explain these, but to understand the basics, mutual funds are funds that are managed on a day-to-day basis or even an hourly basis by an expert. There will be a fund manager who will be sitting and looking after the funds. So if a company is not performing very well, they will be replaced by that fund manager who is looking after the fund. Depending on how the performance is, they might do this on an hourly basis or daily basis, might be weekly. They will ensure the fund is always performing well. An index fund is a fund that is just basically tracking a mutual fund without actually having a fund manager looking after that fund. The advantage between a mutual fund and an index fund is that when you buy a mutual fund, you will be paying a higher fees. You will be paying a higher fees for them to manage that fund because there is an actual expert fund manager sitting there and managing that fund. Whereas an index fund, which is just tracking the same fund, an index fund is not actively managed. Therefore, the fees that you pay for this fund would be much lower. Another type of investment into the stocks and shares market would be by investing in bonds. Bonds are essentially lending money to government or a company. They will be using this money to fund a project that they're running. It could be building a stadium or it could be a company running an internal project. They need money and you will be borrowing it to them. In return, you will get a fixed interest rate over a period of time. Could be 5 years or a 10 years bond. Bonds are generally considered to be less riskier than investing in stocks and shares. For the same reason, the return you will be getting would be fixed, and it's usually slightly lower than an average performing fund in the stocks and shares market. Bonds are also generally categorized into higher risk rates and lower risk rates. The higher the risk is, the higher the chances that the borrower might default on the payments. That means you may never see your money back. When you browse through some of the platforms, you will also notice that there is a cash balance to the account as well. You can store a cash amount in your investment accounts, but a cash by no means is an investment. Majority of these accounts do not even pay you an interest. Storing your money in cash accounts may not reduce the value, as the number would not go down, but if you think in a long run, it would not have the same value when the inflation comes up. On average, there is 1 to 2% inflation every year. If you keep a lot of cash in your account and it's not earning any money for you, that means in 10 years time or 5 years time, your money will lose its value. For example, what you can buy for £1,000 today would not be possible in 10 years time. It's not a big part of stocks and shares investment, but it's worth knowing that some of these investment platforms offer you to store some money as cash as well. It's good for your awareness that there will be no advantage of storing this as cash. Something to keep in mind as a beginner investor is that you need to create a financial goal for yourself before you start investing, because your investment strategy should depend on what your goals are and when you need that money. For example, if your strategy is to have a regular income, then it will be different from someone who wants to have a capital growth over a certain number of years. So if you want to have an income of £500 in 2 years' time, your investment strategy will change depending on that. If you are focused on income or regular monthly income, you would want to focus on more dividend investments. You need to focus on the companies that will pay you a handsome dividend to reach your financial goal. If you want to increase your portfolio, you would want to invest on high capital growth companies. You would want to research on those companies or funds or bonds, however you want to invest. Planning your financial goal is very crucial. Your investment strategy and the investments you make depend on it. Without a plan, you might go and invest in random stocks or random bonds, and it may not satisfy your financial goals in long run. Another thing to keep in mind is trading versus investing. A lot of people confuse trading with investing when they start off. So trading is usually referred to a day trading. A day trading is when you buy and sell the stock usually within a short period of time for a profit. These people usually buy the stocks in a huge quantity and sell it within a short period of time, usually within the same day. To take this approach, you need a lot of knowledge about these companies and keep up to date with all the latest news. This is not recommended for most of the people because majority of the people who follow this route do lose money. Investing, on the other hand, is usually considered a long-term approach. When you're investing, you buy a stock or a share or a fund for a long period of time. You buy it, you will forget about it for 5 years, 10 years, and let it grow over time. Time is your friend in investing. Investing is all about time in the market rather than timing the market. So it's really important for you to differentiate what trading and investing is. Lastly, I want to go over what the term platform is. A platform is just the place where you invest. There are many platforms available out there. You need to pick the right one that suits you. Some platforms only offer investing in funds, whereas some other platforms offer you to invest in funds and individual stocks. Some of them only let you invest in individual stocks. So you need to choose the right platform that suits your needs. Another important thing to consider when you choose your platform is the fees. How much they charge as an account fee, each share dealings, etc. Some platforms have really high fees and can eat up your profits when you withdraw that money. So be careful when you pick a platform and make sure to do your research before you sign up with a platform. Lastly, for UK investors, there is an ISA allowance available in the UK to make use of. ISA allows you to invest up to £20,000, without any tax deductions on any profits you make. So make sure to make use of that allowance every year. The ISA allowance run on financial year, so it will be April to April of next year. If you want to find out more about the ISAs, I have a video available. Make sure to watch that and get full information on all the types of ISAs available in the UK and how you can make use of it. Thank you guys for watching. I hope this helped you. If you enjoyed the video, please make sure to like and subscribe. Thanks for watching, and I'll see you on another video.